Welcome back to Morning Trade Live. We've got futures ready for a strong open. Big tech is positive for the most part, and earnings have been contributing to strength here this morning. Let's talk some more about what's happening among the giants in our market. Thomas Hayes is a chairman and managing member at Great Hill Capital. Thomas, thanks for being here this morning. Walk me through the way you're looking at big tech after these earnings.
Well, Oliver, thanks for having me. The bad news is these were all priced for perfection coming into earnings. The good news is we actually got perfection and then some. So I guess the question is, across these big tech companies that have reported, will it be a case of buy the rumor, sell the news? And I think it's going to be nuanced depending on the name. If you look at Apple, for instance, Apple's trading at 27.5 times next year's earnings, but it's going to grow, 3.1% next year. So, it's pretty elevated relative to its historic multiple of 22 times over the last 15 or so years. But then you look at earnings. I mean, their revenues were up 36% year on year. Their EPS was up 100%. They returned $29 billion to shareholders in dividends and buybacks. And, you look at iPhone sales up 50% year on year. People are a little worried that that's going to slow down next year. Obviously, there was the warning about the potential issues with silicone, i.e. chips. So the market didn't love that. It's trading a little soft this morning. We'll see how that shakes out. And then services, which is the growth story, was up 32.9%. So people certainly, there's a lot to like here. And then people are now looking forward that they got the perfect print. What's next?
The thing that stands out the most to me for Apple, I mean, not that those aren't the huge numbers, especially on the services side, which many people still describe as most important for Apple, beating there handily. Our analyst guest yesterday also pointed out the devices side for wearables is going to be a really big wild card kind of growth story for them. They beat there too. By at least $1 billion. But the thing where they didn't accelerate was the top line growth rate on an annual basis, where last quarter they showed a year over year of 50% plus growth, and now this 36 it's a drop. I mean, it's still an incredible print and rate, but if that's the peak, and analysts do, from what I see here, expect that to be the peak by a pretty healthy margin, Apple would have to just absolutely shock. What does that mean, Thomas?
Yeah, I think, Oliver, you're dealing with the law of large numbers here. I mean, this is a $2.5 trillion company. I mean, maybe we get to $3 trillion, but it starts to become, it's bumping up against that law of large numbers. And
I heard that a year ago. They just did their best growth quarter ever.
Yeah, no, there's no question. Look, he talked about penetration globally. There's a lot of room to run. But there's another overhang, which is that 30% VIG they get on the App Store. There's the Spotify lawsuit in Europe. There's the Video Gamer lawsuit in the U.S. And there's regulators breathing down their necks saying, what value do you provide that you deserve a 30% VIG on every app that gets used on your platform? And if that comes under pressure, the growth story evaporates. And I think that's the biggest risk. Right now, it's intact. Blue skies, everyone's happy. But if that does get chipped away, that's going to be a big issue going forward. So we'll give them the benefit of the doubt for right now. The numbers were off the charts. The outlook is bright. But that's the one thing that I'd be watching in the back of my mind.
And Thomas, what do you think the potential is that we see some of these companies start to trade? I use Netflix as an example, but you could look at a lot of the cloud stocks too that have been struggling over the last 4 months, basically since February, to make new highs. The easiest answer has been basically that their sales growth topped out. But is that more important for, say, a mid-sized cloud company that doesn't have earnings as opposed to an Alphabet or an Apple that's generating enormous profitability?
Yeah, I think, you saw with both Google and Microsoft, their cloud business was flying. So that's going to be helping Amazon on Thursday. But in the case of Google, the cloud business was up 45.73%. That's not too shabby. And in the case of Microsoft, Azure was up 51%. So the cloud continues. The pie is getting bigger is the name of the game. And so people say, well, who's going to be the winner, as if the pie is fixed? They're all going to be a winner. AWS is going to continue to grow. Google Cloud Services is going to continue to grow. Microsoft, even IBM's hybrid cloud will have some benefit. And, looking at Microsoft, which was kind of the darling of earnings yesterday, it's trading at 35 times earnings, next year's earnings, with 7.7% expected growth. So that PEG ratio is a little bit aggressive. And if you look relative to its 15-year multiple, is 27 times. So, we're going to see. I wouldn't be surprised after this is all digested in the next few days if these take a little bit of a breather over the next few weeks. We're in that seasonal time of year before they start to push higher again towards the back half of the year and early next year. But you couldn't find fault in any of these earnings. The only kind of cloud that people were looking at is will iPhone sales slow and what's the impact of the chip shortage? But I think that's all going to get worked out.
Okay. Thomas, when you look at Microsoft and the cloud, right now it's been able to really depart from the group in those cloud companies, as I mentioned, below those highs. What is the possibility here that cloud division again falls into this COVID push forward of demand? The pie may be big and growing, but how much of it did get pushed forward, do you think, here over the past year and a half?
Yeah, certainly it changed people's habits. And I think companies did make a lot of investment last year and this year. But I also think the ones who haven't now have to play catch up. I mean, their whole business is firing on all cylinders. Even if you look at LinkedIn, was up 46% year on year. Everyone was saying, they have all these layoffs. We're worried about LinkedIn. LinkedIn is rocking. MS365, which is kind of, cloud-based for consumers, 51.9 million paid subscribers. Office 365, the commercial version, up 25%. So, and by the way, they returned $10.5 billion to shareholders, which is up 16% year on year. So, Microsoft is really hitting on all cylinders. And I think while there is that concern about pull forward, I think the real question with all of these is not will the fundamental business erode. The question is what multiple are we going to pay? What does that growth rate look forward to? And if you look at all of these multiples relative to their historic multiples, they're a little bit elevated, but the growth is there for now to support that. And then we're just going to have to handicap looking out 2 and 3 years, what happens to that growth rate and what's an appropriate multiple to pay. And as you said in your earlier segment, the name of the game is going to be the discount rate. Where are rates? If we creep it up towards 2% on the 10-year, towards Q1 of next year when the taper talk accelerates, what are those future promised earnings worth? And the answer is less if rates go up. So that's going to be a key factor as to whether these elevated multiples can be sustained.
A nice job bringing us back to our Fed theme for the day. Thomas, really good numbers and a good conversation here after the earnings. Appreciate it.
Thanks for having me.
Good stuff. Thomas J. Hayes, Chairman and Managing Member at Great Hill Capital, with a lot of good numbers on the top of his head post-earnings. Knows his stuff. All right, when we come back, let's dive some more into the response to these figures.